Thank you for standing by. This is the conference operator. Welcome to the Decisive Dividend fourth quarter and year-end 2022 results conference call. As a reminder, all participants are in listen-only mode, and the conference is being recorded. After the presentation, there will be an opportunity to ask questions. To join the question queue, you may press star, then one on your telephone keypad. Should you need assistance during the conference call, you may signal an operator by pressing star, then zero. We remind you that today's remarks may include forward-looking statements and non-IFRS financial measures that are subject to important risks and uncertainties. For more information on these risks and uncertainties, please see the applicable section on Dividend's news release and MD&A, which is on their website and has been filed on SEDAR. I would now like to turn the conference over to Jeff Schellenberg, Chief Executive Officer, and Rick Torriero, Chief Financial Officer. Please go ahead.
Hi, good morning, everyone. It's Jeff Schellenberg. I want to welcome everyone here to our first quarterly earnings conference call. This is a really important step for Decisive Dividend and a milestone marker that is supported by the maturation of our business resulting from the material growth we achieved in 2022. The elements that drove this growth are aligned with the focused approach we are taking to execute on our strategic plan and drive enhanced per-share financial metrics, including our dividend, while behaving in a way that is aligned with our core values, which we call the Decisive Way, thus creating value for all of our stakeholders. For those of you who aren't as familiar with the story, Decisive is an acquisition-oriented company focused on opportunities in manufacturing. The company's purpose is to be the sought-out choice for exiting legacy-minded business owners while supporting the long-term success of the businesses acquired, and through that, creating sustainable and growing shareholder returns. To date, we've acquired 7 businesses: Blaze King, which is a wood stove manufacturer; Unicast, which is a manufacturer and distributor of wear parts for the cement and mining industries; Slimline, which is a manufacturer of agricultural sprayers for orchards and vineyards, as well as wastewater evaporators; Hawk, which is a machine shop that specializes in the manufacturing of downhole tools for the oil and gas industry; Northside, which is a fabricator of steel and aluminum parts that primarily services commercial vehicle and forestry equipment OEMs; Marketing Impact, which produces merchandising products, systems, and solutions for retail customers and displays for consumer packaged good customers; and ACR, which is a wood stove manufacturer located in the UK. I'll now turn the call over to Rick Torriero, our CFO, who is on the line with me here also, to touch on our 2022 full year and Q4 2022 financial results. I will then walk through the key business highlights of 2022 and speak about our outlook for 2023, after which we will open it up for questions.
Q4 2022 culminated a very successful year for Decisive. Q4 2022 sales increased 72% relative to Q4 2021 to $30.8 million, bringing full year 2022 sales to $98.6 million, a 58% increase from full year 2021. The 2022 revenue increases were driven by the 2 acquisitions completed in the year, as well as a 30% aggregate increase in the pre-existing portfolio businesses. Q4 2022 adjusted EBITDA increased 92% relative to Q4 2021 to $4 million, bringing full year 2022 adjusted EBITDA to $13.7 million, a 58% increase from full year 2021. This increase demonstrates the success our businesses had in dropping top-line revenue increases to the bottom line in 2022, despite the labor and supply chain challenges faced through the year. The adjusted EBITDA increases were also a key driver in free cash flow increases in each of Q4 2022 and full year 2022 relative to the same periods in 2021. Q4 2022 free cash flow increased 144% relative to Q4 2021 to $2.9 million, bringing full year 2022 free cash flow to $8.4 million, an 85% increase from full year 2021. I'll now turn the call back over to Jeff.
Okay, thanks, Rick. I'll walk through some 2022 highlights first. 2022 was a significant year for Decisive, with record results achieved as a result of material growth within our subsidiaries and completion of 2 acquisitions. both of which were on strategy and illustrative of our acquisition focus going forward. The elements that drove these results are aligned buy, build, and hold business model. So I'll talk about each of these elements now. There are many business owners walking through decisions about what the future ownership of their company looks like. The CFIB recently reported that 76% of Canadian business owners will be looking to exit their businesses in the next decade. Many of these business owners fit within our target market of what we call exiting legacy-minded business owners, who desire to see their business legacy continue by keeping the businesses they have created operating as going concerns, while providing the opportunity for their employees to maintain their jobs. This drives the buy element of our model and is the story of the two acquisitions we completed in 2022, which I'll discuss shortly. As with the rest of the acquisitions we have made, we do not buy the businesses to sell them, which we refer to as the hold element of our business model. As Rick mentioned earlier, in 2022, while full-year revenue and adjusted EBITDA growth of 58% occurred, but organic revenue growth of the subsidiaries we owned prior to 2022 was 30%, which speaks to the build element of our model undertaken by the subsidiaries, along with the strong demand experienced by our subsidiaries. Ultimately, our ability to create value for our shareholders will be determined by how successfully we drive growth in the per-share financial metrics of our business. In terms of revenue, adjusted EBITDA, and free cash flow less maintenance capex, on a per-share basis, we saw growth of 44%, 44%, and 75% respectively in each of those metrics, illustrating our ability to drive organic growth of our business and complete accretive acquisitions. This growth, especially in free cash flow less maintenance capex which is the key metric we focus on as we set dividend levels, allowed us to increase our dividend to 3 cents per share per month in April 2022, and then again, as announced last week, to 3.5 cents per share per month, which is above pre-pandemic levels. While the dollar amount of our dividend increased in 2022, our payout ratio decreased from 64% in 2021 to 62% in 2022, driven by this growth in free cash flow less maintenance capex. Further strengthening in these per-share metrics will allow us to continue to grow our dividend per share, and which will also support further share price appreciation in the future. So let me talk a little bit about the acquisitions we completed in 2022. The two acquisitions we completed in 2022 were the first acquisitions completed by Decisive since August 2019. The acquisition of Marketing Impact was announced in April 2022. Marketing Impact designs, manufactures, and distributes a comprehensive range of merchandising products, systems, and solutions for retail customers, including grocery stores, convenience stores, and pharmacies. Marketing Impact also designs and manufactures displays for consumer packaged goods customers for use within those same channels. Marketing Impact has a number of key sustainable differentiators that attracted us to this business, including, number one, a track record of product innovation, resulting in having a portfolio of patented products. Two, the proximity and accessibility of their supply chain. And three, their customer service focus. The second acquisition we completed in 2022, ACR Heat Products, was announced in October 2022. ACR manufactures eco-design-ready wood-burning, multi-fuel, and gas stoves and sells them primarily in the United Kingdom. It also manufactures electric stoves, electric fireplaces, and outdoor pizza ovens. ACR was the first acquisition we completed in an industry vertical, in this case the hearth industry, that we had previously invested in. Blaze King, which operates in the hearth industry as well, was Decisive's first acquisition in 2015. ACR is known for its high quality and attractively designed products, and it distributes these products at accessible price points that drive a strong value proposition for its customers. The strong value proposition, the addition of a value brand into our hearth industry product mix, and the ability to accelerate the expansion of the geographic footprint of our hearth industry businesses were key factors in our acquisition decision for ACR. Both of these businesses are a good fit for Decisive's dividend-paying model. They produce a stream of recurring cash flows, are both low capital intensity, were acquired for reasonable multiples based on multiple years of historical results, and had leadership in place for succession purposes when we acquired them. We funded the Marketing Impact transaction with our credit facilities and the ACR acquisition through a private placement with Warthog Capital Advisors, a Toronto-based institutional investor with a strong performance track record and excellent reputation. The investment by Warta was a significant step for our business as it served as a signal of institutional investor readiness for the business, which, along with the performance of the business, has generated significant interest from the capital markets community and other investors. This strong interest, along with the preemptive right negotiated by Warta, which allows them to maintain their current ownership interest in any future offering, is a strong and positive signal around our ability to fund future acquisitions. Consistent with our model, after the completion of these two acquisitions in 2022, we have funded the transactions we have completed to date with 50% debt and 50% equity, supporting leverage returns for our shareholders while ensuring we manage our debt levels comfortably within our financial covenants. So now I'll turn to our outlook moving forward. The results we were able to generate in 2022 are illustrative of our path forward in a number of ways. First, we will continue to work alongside our subsidiary leadership teams to support organic growth of the businesses in a manner that ensures we achieve or exceed our target 15% return on invested capital in each subsidiary. Second, we will continue to focus on further diversifying transactions similar to Marketing Impact, along with transactions that can add businesses to our portfolio in verticals we are already invested in, similar to ACR. The scale of the opportunity in front of us, as articulated by reports such as the FIB report referenced earlier, means there are a massive number of opportunities in front of us to continue to grow our business via acquisition, creating further value for all of our stakeholders. As stated in our inaugural shareholder letter that was released yesterday, our execution around both of these growth channels has resulted in a 38% aggregate ROIC to date on our investments, which has created significant value for our shareholders. In 2022, we returned $4.6 million to our shareholders in the form of dividends, and with the dividends paid to date in 2023, that brings the total amount of capital returned to shareholders in the form of dividends since 2015 to $20.6 million, where our share price increased 24% in 2022, rewarding our shareholders with capital appreciation plus income. Finally, the support of our financing providers, including our lender, CWB, and our investors like Warta, provide confidence around our ability to fund the acquisition of high-quality, immediately accretive, strategically aligned acquisitions in the future. I would be remiss not to highlight the impact our leaders at the board, head office, and subsidiary levels have had on driving the performance we experienced in 2022. We've made significant changes in our subsidiary leadership in 2022 and into 2023, bringing in new presidents at Hawk Machine Works, that's Tim Stewart, Unicast, Mark Watson, and Slimline, Daryl Lowry, who started most recently on February 13th, 2023. Each of these leaders has had an immediate and material impact on the businesses they lead, which we believe will position these businesses to continue to experience organic growth that drives returns for our shareholders. Our leaders at Blaze King, Alan Murphy, and Northside, Mark Burley, also drove their businesses to strong performance growth in 2022. We were also able to add to our leadership team by acquisition, with Alex Valoria at Marketing Impact and Jason Searle at ACR being in a position to drive organic growth in these entities as we move forward. At our head office, the work done by our COO, Terry Edwards, in supporting our subsidiaries, and Rick Torriero in overseeing the financial functions at head office while supporting our subsidiaries, are critical to our overall success. As we look to the future, we're focused on building on our capabilities to support further organic growth and growth by acquisition. Tyler Semp, our Corporate Development Manager, is doing a tremendous job of sourcing high-quality, strategically aligned acquisition opportunities. Building out our team to ensure that we are in a position to complete our diligence processes on more than one opportunity at a time will be critical to our future success in scaling out our acquisition capabilities. We have been adding and will continue to add to our team to be able to achieve that. Finally, the oversight of our board of directors, led by James Patterson, has been highly instrumental in the growth of our business to this point and will be into the future as well. Much has been made about the economic challenges being experienced as a result of rampant inflation, rising interest rates, and overall economic uncertainty. However, given the nature of our diversified mix of portfolio businesses, each of which has significant organic growth opportunities in front of it, along with the number of acquisition opportunities we are seeing, all supported by the high-quality leadership team we have in place and are continuing to build, gives us confidence that we will be able to respond to challenges as we face them while we're relentlessly pursuing forward progress in the business. Decisive Dividend is a story of growth and yield, and we took significant steps forward in both regards over the last year, and are confident that we can continue to deliver on both the growth and yield components in 2023 and beyond. With that, we'll now open up the call for questions.
Thank you. We will now begin the question and answer session. To join the question queue, you may press star, then 1 on your telephone keypad. You will hear a tone acknowledging your request. Please limit your questions to 2, and should you have any additional questions, please re-enter the queue. If you are using a speakerphone, please pick up your handset before pressing any keys. To withdraw your question, please press star, then 2. We will pause for a moment as callers join the queue. The first question comes from Ty Collin with 8 Capital. Please go ahead.
Hey, good morning, Jeff and Rick. Congrats on a really solid end to the year here. My first question may be one directed towards Rick. I'm wondering if you could talk us through some of the moving pieces in the finished product segment in particular from a revenue and margin perspective. Q4 looked like a real strong revenue quarter, maybe a little bit lighter on margins compared to the rest of the year. So could you help me understand how much of that was maybe related to seasonality or the consolidation of ACR, or maybe what was just organic movement?
Yeah, you bet. So in Q4, one of the main drivers was product mix with Marketing Impact. They had some really strong sales in the quarter. A big part of that is shipping costs that they actually bill out to their customers at fairly low margins. So the shipping costs, generate nowhere near what their products do in terms of margin, and that was pretty significant with a large order they had for a significant customer across Canada this last Q4 ahead of the holiday season. So that was a big part of it. Plus, we did witness some margin compression in the slimline business, both on the evaporator side and on the sprayer side, compared to what we'd seen in the prior quarters with their early buy program on the sprayers and just some contract nuances with an evaporator sale.
Okay, that's really great color. Appreciate that, Rick. And then for my follow-up question, so guys, I know you and the team set fairly ambitious organic growth targets for each of your subsidiaries, and you spoke to that earlier in the call. It certainly looks like most of them hit and even exceeded that mark in 2022. So I'm just wondering what level of organic growth you're targeting across the business in 2023, understanding that maybe 2022 was a bit of a catch-up year for some of these businesses coming off the pandemic.
Yeah, no, that's a really good point, Ty. I think, what we saw across the board was that each of our subsidiaries achieved the organic growth levels that we set for them. I mean, obviously, we talked about a 15% return on invested capital. That kind of sets the mark in terms of how we think about the level of organic growth we look to achieve or expect to achieve from our subsidiaries in any given year. And our teams delivered. I think we really established this target coming into 2022, and the teams, I think, responded really well to that and built their plans around, what it took to achieve that type of level of growth, which was tremendous to see. Well, I agree with you, a bit of a lower base coming off pandemic years for sure, but I think what we saw, the progress we saw around, the steps they took to achieve those growth, that type of growth was really encouraging for us to work alongside them as they executed around that. So that was terrific. Our expectation is the same thing going into, I think there's different, types of hurdles facing each one. I think what we'll expect to see in 2023 is some will exceed far in excess, some will hit that, and some may be a little bit less than that. I think what our plan is to work with them to like we said, develop their plans as to what are the steps the business needs to take to achieve the type of organic growth we need to achieve to create value for our shareholders, and then strategically invest to do what it takes to be able to get there. So that's that's consistent with how we approach 2022 and consistent with how we're thinking about 2023 as well.
Great, thanks for the questions, guys.
Yeah,
thanks, Ty.
The next question comes from Kyle McPhee with Cormark Securities. Please go ahead.
Hey guys, good update. I just wanted to talk a bit about the two most recent acquisitions, Marketing Impact and ACR. As you disclosed with the Q4 update, both are tracking at revenue rates well above the acquired revenue rates you disclosed at the time of the deal last year. So starting with Marketing Impact, can you speak to where those gains are coming from and whether or not you can hang on to those gains or hopefully even build on them throughout 2023?
Yeah, so I think, what we saw with Marketing Impact this year is their team did a tremendous job, especially on the display side of their business that far exceeded, typically, that would be about half of their business. They performed well in excess of that in 2022, based on the strength of performance of their team driving the sales in that side of the business. A couple pretty material contract wins. Rick referenced one, in particular that drove some shipping expenses, but that drove a bunch of their top line growth and overall strength in the business. So I think the display side was something that, was the performance of which was really impressive. I would say, I think there's we'll see more of a focus around the merchandising piece of their business in 2023, which I think is more easily scalable than the display side of their business. And this low-hanging fruit, they've had a lot of focus, I would say, on the Eastern Canadian markets and have recently hired new sales personnel to focus more so on Western Canada and the U.S. And we're really optimistic about the type of growth that they can achieve just through execution around and have the pieces in place to do that on the merchandising side, which I think is pretty exciting to see. So I think they're on track. I think the team there is really focused on finding ways to continue to build their business and build their scalability, which is exciting for us to see. So that's where that's the comments I'd make on Marketing Impact.
Perfect. Thanks for that color. And then on ACR heat product, same type of question. The macro setup in the UK seems like it's supportive of big gains for that business throughout this year, building on last year. Does that align with what you see? Can you maybe speak to does that align with what you see, and can you speak to whether or not your third-party manufacturers there have capacity to support growth that might show up?
Yeah, no, excellent question. Yeah, so we continue to see extremely strong, tremendous demand in 2022, really driven on the back of rising costs of energy availability, and rampant inflation. When you have double-digit inflation in the UK, which is what that market is experiencing, a value product in the face of some of these challenging energy dynamics made the ACR product, which is a product that meets the regulatory requirements, is really attractively designed, but also has an extremely attractive price point. It made that product a really attractive product in the market. They also did, the third-party manufacturing arrangement they have actually allowed them to meet demand in a more timely basis than a lot of their competitors did as well, which created, I think some of the growth they experienced was the fact that they could actually meet demand versus some of their competitors who manufacture their own products. So that's tremendous. Jason Searle, our managing director of that business, has done a tremendous job of building out, and it is constantly on the hunt for new manufacturing partners to help support them to be able to meet the demand. And he's soaked up a lot of the manufacturing capacity of some of his third-party suppliers in order to meet the expected demand in 2023. A lot of which is planned out in advance and kind of gives us a sense of the type of scale we can generate. And so he's done a really good job of that. But on top of that, he's also looked to diversify our third-party suppliers to really benefit the business as well, including making, last year in 2022, he made a shift of a particular product from a European manufacturer to a Chinese manufacturer that resulted in significant margin gain on a product that we were manufacturing anyways. So I think, that the team there has done a great job of positioning the business to be able to meet the demand. Obviously, we're seeing a bit of a drop in natural gas prices in that market now, and I think actually what they're seeing as a result of it is some pickup in their other product lines. Actually selling some more natural gas products and electric products and seeing some demand for that, which is encouraging to see, and something that we really like about the ACR business is that they have a multi-line product. They have the wood burning product that's been a tremendous driver of growth in 2022, but they also have the natural gas and electric products that as, kind of the energy dynamics shift, they can reposition themselves and order more of the product that's moving at any given time. So yeah, which leaves us in a really good position going into 2023, which we, in a period we expect to see continued strong demand for the products they manufacture.
Got it. Thanks for all that color. On Blaze King, your longest-standing portfolio company and your biggest revenue contributor, you've been delivering year after year of growth with that company. Another big year in 2022. You've made it clear that the EPA regulations and the U.S. tax credits have been a big tailwind. What are you expecting now going forward, near midterm, in terms of growth that is up such a long track record of growth in the trailing periods? Maybe speak to backlog or volume opportunities you may still be seeing.
Yeah, because of the strength of demand for their product, and Blaze King's a very different product than the ACR product. This is a premium product that has some really unique capabilities, but also is an incredibly efficient product that drives its attractiveness with respect to the EPA regulations, where we produce the number 1 and number 2 most efficient wood-burning stoves in North America through Blaze King. And, given those types of dynamics, as well as the energy cost dynamics in North America, we entered 2023 with a significant backlog and a record backlog in that business coming into the year, which gives us a lot of comfort around, what the results will be, given the size of that backlog. So, I'd say we continue to see strong orders. I'd say it's order amounts have tempered a little bit, but because of the ongoing orders plus the backlog, we have pretty good comfort around what their performance will look like into 2023. So, the products they produce 10% of the products that are eligible for the tax credit that's in place in the U.S. to replace new energy or older non-efficient energy producing products to new efficient products. And so we really continue to see that as a strong tailwind for the demand they're going to experience for that product, which is obviously encouraging for us as we move forward here.
Got it. Thanks, guys. I'll hand it off.
Thanks, Kyle.
The next question comes from Christian Nelson, a private investor. Please go ahead.
Hello. Thank you guys for your time. My question is, what's your targeted, or if you have a forecasted estimate for how many acquisitions you plan on completing in the 2023 calendar year?
Yeah, excellent. Thanks, Christian, for the question. So just to look backwards a little bit on this, in 2022, we completed the 2 acquisitions, but that represented about $4 million of EBITDA that we acquired to contribute to our business. I think that's something that was in line with the target that we had for 2022. And I think the key for us as we move forward is, number 1, there's tremendous opportunity set. As we talk about reports like the CFIB, that's not just in theory, there's this number of businesses that are going to be sold. That's in practice. And we continue to see a really strong flow of new acquisition opportunities into our business on a kind of a daily, weekly type of basis. So there's a tremendous supply of these types of acquisition opportunities out there for us. Number 2, with the scale of our team right now, we're almost in a situation where we can do deals consecutively, like one deal at a time moving forward. Now, we've aligned ourselves with different third parties who we can work with that allow us to scale up a little bit around that. But to be able to do much more than we did in 2022, we're going to have to build the team out because, of just the amount of work it takes to bring on these types of acquisition opportunities. So we're very focused on doing that. And I think as we do that, we would expect to see our ability to execute on more deals scale up. So I think for us, that's something that you can see as we continue to build our team, and as these trends continue to carry out, our objective is obviously to increase the amount of deals. And really, we think about it from a dollar value perspective in terms of the amount of earnings that it contributes to our portfolio, more so than particular number of acquisitions. But yeah, that's I guess how I'd respond to that question, Christian.
Okay, thank you very much. I'll pass it on to the next person. Thank you.
Thanks, Christian.
Once again, if you have a question, please press star, then 1. The next question comes from Kyle McPhee with Cormark Securities. Please go ahead.
Well, again, on the dividend policy, what should we expect going forward in terms of Decisive revisiting the dividend level and deciding on increases? Is this a fixed interval type decision or random timing based on what you see with the distributable cash flow as you grow organically and through M&A?
Yeah, that's a good question, Kyle. I think, what we think is an important step in actually disclosing how we think about both our payout ratio, both from a numerator and denominator perspective in our Q4 disclosure, which I think was important to see. And what you saw was, like I mentioned in the comments, you saw our payout ratio decrease while the dollar amount of our dividend increased, which is demonstrates a really healthy dynamic. I think what we're focused on is ensuring that we can deliver sustainable and growing dividends. So I think this is a regular conversation topic with our board. We consistently reassess our free cash flow less maintenance capex on both a trailing and forward-looking basis to be able to assess and ascertain how well supported our dividend is currently, but also if there's an opportunity to potentially increase it. And so that's something that we do regularly with our board. I think what the key words are sustainable and growing. I think we've done dividend increases now in each of the past 3 years. I think this is a priority for us to be able to continue to do it. I wouldn't say that we're on a right, like obviously we increased the last 2 times we increased were in April. I don't think that's necessarily a commitment on our part that it's only going to be in April that we're doing it. It's more so around the assessment of both from a trailing perspective as well as a forward-looking perspective. If we think an additional amount of dividend payment would allow us to remain on side the ratios we have in place, but also supported by future cash flows as well.
Got it. Thank you. And then last one from me. Can you provide any color on CapEx levels for 2023? Are there any notable growth CapEx budgets moving forward that could materially change your typical capital intensity across the portfolio of companies?
Yeah, so I think what you saw in 2022 was about just slightly over 2% of capital intensity, the amount of CapEx per amount of revenue that we generated for the year. I think from a maintenance CapEx perspective, I would expect us to be right in that ballpark again for 2023. I think the way we think about our growth CapEx is similar to how we think about acquisitions. We need to see that particular investment generate a 15% return on invested capital. If we're not able to see that type of return, we can't approve. I guess we have the balance sheet at head office. We allocate capital to our subsidiaries. They come to us with their growth plans or requests for capital, and then we allocate based on whether or not we think we can generate that type of return. So that I think there'll be we look at really growth CapEx as something where we'll probably fund, or we would fund probably up to another 2% of revenue from a growth CapEx perspective and allocate it amongst the group. But that's entirely dependent on whether we're able to generate a 15% return on invested capital by making that investment. So that would be kind of gives you a bit of the bookends of where we might be from a CapEx perspective in 2023.
So that's good color on the thought process around it. But I guess, are you seeing 15% plus ROIC growth CapEx opportunities that you'll be spending on in 2023?
Yeah, I think we are. I think what we made some investment in Hawk Machine Works as an example last year that ended up generating a tremendous ROIC, and I think what we'll see is some further growth CapEx investment in that business just because of the success it's having. around generating a return on its investment. There's some other opportunities we're seeing as well that we think can generate kind of immediate impact as well in a number of different subsidiaries. So there are definitely those types of activities, but I think what you'll see is it'll remain within those kind of bookends we talked about here just a second ago.
Got it. Okay, thanks. That's it for me.
Ladies and gentlemen, this concludes the question-answer session. I will now turn the call back to Jeff Schellenberg for closing remarks.
All right, everybody. Well, we just want to thank you all for attending our Q4 and year-end 2022 conference call. Our first call here, I think, was a successful call, and we look forward to updating you on our progress continuing into the next quarter and beyond. So thanks for attending.
This concludes today's conference call. You may disconnect your line. Thank you for participating and have a